Money is changing, not slowly, not quietly, and not in a way most people understand. A few hours ago, Andrei Jikh broke down one of the most important financial shifts of this decade: digital identity, stablecoin, programmable money, tokenized assets, AI surveillance, and the possibility that the same technology sold to us as convenience could become the infrastructure of control. That analysis matters. But this episode is about the part most crypto and finance videos do not show. What happens when your identity, your money, your movement, your purchases, and your savings all begin to merge into one digital system? Welcome back to Broken Economy. Today, we are looking at the new digital money grid, not as science fiction, not as panic, but as a financial structure that is already being built. Because the future of money is not just about whether dollars become digital. The real question is, who controls the rules inside the money? The first pillar is digital identity. World ID, originally connected to WorldCoin, is built around a simple idea. In a world where AI can fake voices, faces, videos, messages, and entire online identities, people will need a way to prove they are real humans. That sounds reasonable. Deepfakes are real. AI fraud is real. Bot networks are real. Online trust is breaking. So the sales pitch is simple. Scan your identity once. Prove you are human. Use that proof across the internet. So, Tina, Shopify, DocuSign, enterprise systems, payment systems, social platforms, work platforms. At first, it sounds like convenience, but the darker question is this: what happens when proof of humanity becomes required for normal life? What happens when you cannot date, work, shop, sign, travel, trade, or transact without a verified digital identity? What happens when being human is no longer assumed, but must be authenticated through a platform? That is the identity trap. The issue is not only privacy, the issue is dependency. Once digital identity becomes the gatekeeper becomes powerful. If your identity is required to access the economy, losing access becomes a form of economic death. You may still be alive, but you may not be able to participate. That is why digital identity matters. It is not just a login, it can become the root key to your economic life. The second pillar is programmable money. Stablecoins are being sold as faster, cheaper, more efficient dollars, and in many ways, they can be useful. They can move 24/7. They can settle quickly. They can support global payments. They can lower transaction costs. They can bring dollar access to people outside the banking system. But every powerful technology has two sides. A stablecoin is not just money, it is software. It runs on code. It depends on issuers, reserves, compliance systems, wallets, blockchains, exchanges, banks, and regulators. That means the future dollar may not only move through banks, it may move through programmable rails. And once money becomes software, people start asking new questions. Can transactions be blocked? Can wallets be frozen? Can certain addresses be blacklisted? Can money be restricted by compliance rules? Can financial access be connected to identity? Can payments be monitored in real time? Can stablecoins become a new distribution system for treasury-backed digital dollars? These questions are not fantasy. They are the natural questions of a world where money becomes infrastructure. The Genius Act created a federal framework for payment stablecoins. It requires regulated issuers, reserves, compliance, anti-money laundering controls, and supervision. Supporters say this brings safety and legitimacy to stablecoins. Critics say it also brings stablecoins deeper into the official financial system. Both can be true. Regulation can reduce fraud, and regulation can also make digital money easier to integrate into government, banking, compliance, and surveillance systems. That is the tension. The same law that makes stablecoins safer can also make them more controllable. The third pillar is the debt machine. This is the part most people miss. Stablecoins do not exist in isolation. Many dollar stablecoins are backed by cash, bank deposits, treasury bills, and other short-term liquid assets. That means, if stablecoins grow, demand for short-term US government debt may grow with them. This is where the digital dollar story connects directly to the national debt. The United States has a massive debt problem. The government needs buyers for its debt. Foreign governments are diversifying. Central banks are buying more gold. Treasury issuance keeps rising. Interest costs are growing. And the financial system needs new demand for US debt. Stablecoins may become one of the new pipes. Instead of only relying on foreign governments, banks, pensions, and institutions, the system can package dollar demand into apps, wallets, exchanges, and payment platforms used by ordinary people around the world. That is the hidden genius of the stablecoin system. It does not only digitize dollars, it can globalize demand for dollar-backed assets. You think you are holding digital cash, but behind the screen, the reserve structure may be holding treasury bills. That means the ordinary user may become part of the funding layer for the US debt machine. Not directly, not consciously, but structurally. This is the part Andrei Jikh is pointing toward. If the old buyers of US debt become less reliable, the system needs new buyers. Stablecoin users can become the new distributed buyer base. 1 billion small wallets can do what a few big foreign central banks used to do. That is not automatically evil, but it is important, because once your digital money is backed by the debt of the system, your wallet is not outside the machine, it is inside the machine. The fourth pillar is surveillance hardware. Money and identity are not the only parts of the grid. Modern life is becoming measurable. Phones, cars, cameras, apps, payment systems, smart devices, location data, work platforms, delivery systems, insurance, telematics, biometric verification, driver monitoring, AI fraud detection. All of this creates a world where behavior becomes data, and data becomes risk scoring. This does not require one giant conspiracy. It happens because every company wants to reduce fraud. Every regulator wants compliance. Every insurer wants better pricing. Every platform wants trust. Every bank wants risk controls. Every government wants enforcement. Each individual reason sounds reasonable, but the combined result is a society where more and more of life becomes trackable, scorable, and controllable. That is the control grid, not one switch, 1,000 small systems connecting. Now think about the car. New vehicle safety rules are pushing advanced impaired driving prevention technology. Supporters say this can prevent drunk driving and save lives. That is a serious goal, but critics worry about monitoring, false positives, remote intervention, privacy, and future expansion. Again, both sides have arguments. The safety case is real. The control risk is also real, because once a system can detect, monitor, and intervene, people will ask how far that intervention can go. Could insurance companies use driving data to change rates? Could regulators use vehicle systems for enforcement? Could vehicles become part of the identity and payment grid? Could access to mobility become conditional? These questions matter because freedom is not only about money, it is also about movement. If money becomes programmable and movement becomes monitored, the space for private life shrinks. Now add AI. AI makes the system more powerful because it can connect patterns across data, payments, location, identity, social behavior, work history, risk signals, purchasing patterns, travel behavior, speech, video, biometrics. AI can turn separate data points into a profile. That profile can be used for security. It can also be used for exclusion. A system does not need to jail you to control you. It only needs to make normal life conditional. Conditional access to payments. Conditional access to platforms. Conditional access to mobility. Conditional access to work. Conditional access to credit. conditional access to insurance. That is why the phrase, if you have nothing to hide, you have nothing to fear, is dangerous. Because the question is not whether you are hiding something. The question is who defines risk, who writes the rules, who updates the model, who audits the errors, who controls the appeal process, who decides when your access returns. That is the real issue. In a digital economy, a mistake is not just a mistake, it can become a lockout. The fifth pillar is the 401k and retirement system. Most people think this digital money story is separate from retirement. It is not. The same financial system that wants digital identity and stablecoin adoption also wants every asset to become more liquid, tokenized, and integrated. Larry Fink and other financial leaders have talked about tokenization as a future of markets. The idea is that stocks, bonds, funds, real estate, and other assets can eventually move on digital rails. That could make markets more efficient. It could reduce settlement times. It could expand access. It could lower friction. But it also means retirement assets may become more deeply connected to programmable financial infrastructure. Your 401k already ties your future to the market. A tokenized financial system may tie your future to even more automated rails. More speed, more access, more liquidity, more surveillance, more compliance, more control. The promise is efficiency. The risk is dependency. When every asset becomes digital, every asset can be monitored. When every transaction becomes programmable, every transaction can be conditioned. When every wallet is tied to identity, financial life becomes transparent by default. That is why this matters to ordinary people. This is not just about crypto people. It is about anyone with savings, anyone with a paycheck, anyone with a retirement account, anyone using digital payments, anyone driving a connected car, anyone shopping online, anyone trying to survive in a world where cash is disappearing. Now let's bring this back to the street. Imagine a worker in Southern California. They make decent money, maybe even 6 figures, but rent is high, gas is high, insurance is high, groceries are high, credit card debt is expensive. The 401k is exposed to market volatility. The dollar buys less. And now, the financial system says, here is a faster digital dollar. Here is a safer identity system. Here is a smarter payment rail. Here is a verified human login. Here is a wallet that works everywhere. Here is a system that reduces fraud. Here is convenience. But the worker should ask, what am I giving up? Am I gaining freedom? Or am I trading privacy for access? Am I gaining financial protection? Or am I becoming part of a treasury-backed digital funding machine? Am I getting better money? Or more controllable money? Am I getting a safer internet? Or a gatekeeping system that can decide whether I am allowed to participate? Those are the real questions. This is why the digital economy is so difficult. It is not all bad. There are real benefits. Fraud is real. Deepfakes are real. Identity theft is real. Payment delays are real. Banking access problems are real. Stablecoins can be useful. Digital ID can solve some problems. Tokenization can improve some markets. But broken economy is not here to read the sales brochure. We are here to examine the structure. And the structure is clear. Identity is becoming digital. Money is becoming programmable. Assets are becoming tokenized. Cars are becoming monitored. AI is becoming the decision layer. Debt is becoming harder to finance. And ordinary people are being pushed into systems they do not fully understand. That combination deserves scrutiny. Because once the grid is built, opting out becomes harder. At first, it is optional. Then it is convenient. Then it is required by platforms. Then it is required by employers. Then it is required by banks. Then it becomes normal. And once something becomes normal, resistance looks irrational. That is how major systems change. Not through one dramatic law, through adoption, through convenience, through fear, through crisis, through incentives, through defaults, through people saying, it is just easier this way. That is the slow path to total transparency. And total transparency always sounds clean from the top, but from the bottom, it can feel like life under permanent audit. Now, what should ordinary people watch? Watch stablecoin regulation. Watch which assets back the biggest stablecoins. Watch treasury bill demand. Watch World ID integrations. Watch biometric identity systems entering normal apps. Watch payment platforms adding compliance layers. Watch tokenization of real-world assets. Watch vehicle monitoring rules. Watch banks linking identity to wallets. Watch whether cash becomes harder to use. Watch whether financial access becomes more conditional. And watch the language. When they say safety, ask who controls the switch. When they say convenience, ask what you can still do without permission. When they say innovation, ask who owns the data. When they say inclusion, ask who can be excluded. When they say programmable, ask who writes the program. That is the key question. Who writes the program? Because the future of money is not only about what you own, it is about what your money is allowed to do. And if money becomes permissioned, then financial freedom changes meaning. Cash used to be simple. You held it. You spent it. No login. No account freeze. No biometric scan. No algorithmic approval. No platform risk. Digital money is different. It can be faster. It can be smarter. It can be safer. But it can also be supervised. It can be tracked. It can be frozen. It can be integrated. It can be conditioned. That is the trade-off. And the public deserves to understand it before the system becomes permanent. Andrei Jikh explained the warning. Broken economy is showing the structure underneath. This is not about rejecting every technology. It is about asking whether the future is being built for human freedom or institutional control. Because in a broken economy, wages keep you alive. Assets give you a chance to escape. But if money, identity, assets, and movement all become permissioned, then even ownership may become conditional. That is the real fear. Not that technology exists, but that access to economic life becomes something granted, monitored, and reversible. Go to the comments and tell us what you think. Would you scan your eyes for a world ID if it became the easiest way to prove you are human online? Would you hold a regulated stablecoin if it was backed by treasury bills? Would you accept programmable money if it made payments faster and cheaper? Where is the line for you? Identity, money, cars, retirement accounts, AI, risk scores, and what is your exit asset if the dollar becomes fully digital? Gold, Bitcoin, real estate, cash, productive businesses, or is there no real exit once the grid is everywhere? Subscribe to Broken Economy for more clear breakdowns of finance, technology, markets, power, and the real economy behind everyday life. Stay awake. The future of money is not just digital, it is programmable, and the most important question is, who gets to program it?